On this episode, we're going to talk about oil backwardation. As of the timing of this video, oil is still, largely speaking, backwardated, and it's something that we've been focused on for many months. While the oil backwardation has improved in some regards, it's still incredibly vital to watch it and to understand its impact on energy policy, its impact on oil equities companies and their CapEx, as well as just the overall environment of inflation. Now, in this video, we're going to talk about what oil backwardation is. We're going to talk about the impact of oil backwardation on company decision-making. Finally, we're going to talk about governmental policy as of current in lieu of this oil backwardation. And finally, I'm going to talk about some things to consider if you've got oil stocks in your portfolio. It might be relevant for the oil commodities as well, but I only do stocks and options. I don't do futures and forwards. But before we get into that, past performance is not indicative of future returns. You should absolutely consult a professional to make sure that any ideas that you have for your own investments meet your investment criteria. Markets with May on YouTube is the free version of my subscription channel, which is available at gurula.net. Additionally, if you find this content helpful, it would be amazing if you could like this video, share it, comment below, or subscribe to my station. Now, let's get into oil backwardation and what exactly is going on here. Now, interestingly enough, oil backwardation is not so terribly different from the concept that I presented in a different video called interest rate inversion. And what really is happening here is that the front contract, the one that expires closest to current period, is priced at a price that is higher than contracts that are farther back, that don't expire for many months in the future. And someone is printing out this curve graphically. A lot of times it looks inverted in the same way that an interest rate curve looks inverted in that. And so when you graph the price of oil on each of the months, it just gets lower and lower, with the front month being the highest priced month. Now you might think, what's the big deal? Oil is constantly gushing out of the ground, and so it's not like interest rates.
Bubbling crude oil, that is, black gold, Texas tea.
But in fact, there are some very distinctive similarities. In particular, what's very important to note is one of the major contracts, which is West Texas, WTI is what it's usually abbreviated as, is a physical delivery contract, meaning that when that contract expires, you got to come up with oil. Now, there is a non-physical delivery contract called the Brent crude contract, and that one is usually used for hedging. But WTI is a legitimate contract where people expect to take delivery of the oil. As such, as you go farther back, because there's storage costs, because there's transportation costs to the hub, the actual physical location that you would need to pick the oil up at. So it should be the case that as time goes further, because of storage costs, because of delivery costs, things should technically go up. It should be in contango. It should be kind of going more and more steep on the curve. There are some caveats to that. The first thing is that there is absolutely seasonality to oil usage. In the summer months, we drive more. In theory, jet fuel is used more. And then you've got the swap of that in the southern hemisphere. Still, the northern hemisphere has most of the population in the world. So it's really those summer months that hit the hardest. In the winter months, you do have some refining that turns it into nat gas, but additionally you have heating oil. And quite frankly, there are periods in the winter month where you do have increased jet fuel usage. So there is definitely seasonality that dictates how precisely the shape of the oil curve goes. Now, no matter what commodity you're looking at, this concept of contango and backwardation exists. In a lot of ways, you're going to want to look at the seasonality in the same way, no matter what commodity it is. And additionally, you're going to want to know if that contract is physical delivery, meaning there's a storage cost to it, there's transport costs, there's a specific place people pick it up, or if it's cash settlement. Those things can really dictate what's going on with the shape of the curve. But largely speaking, contango makes the most sense, and backwardation implies something very specific. I wanted to make this video in particular on oil because the volatility in that market has been extra, for lack of a way to describe it. And it's been really impacting everything having to do on the planet as relates to inflation. It has to do with everything as relates to oil policy, what oil companies are doing in their decision making. And what you kind of have to know in the history there is that when COVID first hit and travel went to a grinding halt and so many companies just kind of shuttered, oil prices in general, the whole entire complex just got crushed. We had $30 oil prices and so much oil in storage that you couldn't give it away. Now, as a function of that, all of the oil companies capped their rigs, which means that they essentially stopped producing oil as best they could. Rig counts went down dramatically, and oil production went down massively. Now, as the economy started up again, oil prices began to recover, but they really recovered in the front immediate months more so than the back months. And there were a number of reasons for that. At first, it was because it was unclear if we were going to go into a second COVID lockdown. And so oil companies were a bit more cautious. Because the thing is, the back part of the curve dictates what the price is going to be in the future. It gives you the market implied price for what people think is going to happen 6 months out, a year out, 2 years. Well, it turned out that although we had recovery of the oil price on the immediate, for example, last summer, we started to see people go back to travel and kind of open up a bit. We weren't necessarily seeing the oil prices shoot up above and create that beautiful contango. Instead, we were still seeing the back part of the curve in a lot of ways, in some cases during the summer, below $60. Now, it's important to understand that here in the United States, we are blessed with not only a low cost to the production of oil. In some cases, companies can make money with oil under $50. But also, we produce a type of oil called light sweet crude, which is easier to refine. A lot of other countries, and definitely offshore, typically needs oil to be well over $60 for it to be break even. And a lot of the oil that's produced in other nations, as well as offshore, is not light sweet crude, meaning it's a little bit more painful to take all of the impurities out to refine it down to what can be used for the various use cases of oil. In October, November, December of last year, it was still very hard because the oil curve was backwardated to make decisions on additional new capital expenditure. And that really had to do with the fact that even though the front was cresting in the high 70s over 80, the back part was still staying very compressed. In some cases, it was dancing below 60 on some days. In other cases, it was just above 60. You still have to bake in the cost of hedging. And especially if you're going to bring in new capacity offshore that you know is going to really require a good price above 60 to be profitable, it's just really hard for the oil companies to go there. Now, you do have some overseas fields that can make money with oil sub 60, but largely speaking, a lot of it did still require that push upwards. Now, whereas in the past, a lot of people wouldn't necessarily know the impact of high oil prices on the economy, I think this year we're all feeling how high oil prices and the inflation therein is affecting literally everything. Oil is used to make products. Oil is used to transport products, driving our cars and heating our homes. And so it's no surprise, as we were still trying to figure out whether or not our economies were going to recover on the permanent, that the Biden administration was really concerned in the October time period when we started to see oil inch over 80, which, by the way, is itself a fairly high number, even though we're seeing oil much higher now. Now, the Biden administration began talks with the oil companies. In fairness, they always have talks with the oil companies. But by November 23rd, they decided to release reserves into the marketplace. And for a time, that lowered the energy price from around the 84-ish level down to the 60s. And there was a lot of hubbub about this. At that time, markets with maize started to become incredibly bullish oil because this synthetic letting of oil in December, we didn't think would do very much because it wasn't enough from a volume perspective to make up for what was potentially going to happen as relates to the winter months. Now, I think what the Biden administration was hoping for was that by pushing down the spot rate of oil, it would bring prices a little bit into equilibrium and they might get a lift in the back part of the oil curve. Instead, what happened was they just pushed the whole curve down. That didn't help very much, since, as I mentioned, CapEx decisions are going to be made on the back half of the curve. I think most energy professionals knew that the releasing of reserves in December was not necessarily going to do very much, especially given the size of the release, as well as the fact that it was happening in December before the true winter season hit in a meaningful way. You know, the amount of oil that's demanded if temperatures drop below a certain amount is pretty high. And unfortunately, we had some pretty cold weather in the month of January and February throughout the United States. Those cold temperatures started to come in. You saw the front end of the curve begin to lift again in January, and it just kept getting higher and higher, especially as a lot of the news flow items started to come out as relates to OPEC and their very, very marginal change in what they're capable of doing because they were already running at capacity. And then we start to get this noise that's happening in Russia and Ukraine. Now, during the fourth quarter, when companies were reporting earnings, many did report as early as that first week of February before the Ukraine-Russia crisis, and they were seeing from the previous quarter oil prices that were still sub 70, given how oil had behaved in the December month. But they were all seeing, with the tight constraint in OPEC and what the back part of the curve was doing, a bit of a pause on what to do next. The curve was telling them that this was not the right decision to jam a bunch of money into CapEx and increase production. And that was despite the fact that the front part of the curve was extremely elevated. But still, the winter was getting colder and colder, so the demand in the front part of the curve just kept lifting it up. And it really was lifting it up at spot, not necessarily farther back on the curve, because so much of the Paris agreements and the various things that had been said by the Biden administration made it seem like energy prices would drop precipitously as soon as we got out of the winter months and certain types of renewable energy came online. Now, some people disagree on this because it is the case that the renewable energy sources that come online were going to take CapEx of multiple years. I think some estimates that I saw that made more sense were like 3 to 5 years. Nonetheless, the back part of the curve was staying stubbornly below the $75 level. In some cases, if you went far enough back, you were kissing 70 exactly. And it was unclear how to think about that from a CapEx perspective, given rising labor costs, given all these other things. Certainly for the onshore, there was some kind of thought process that one should at least prove out the unproven reserves. But for offshore, because there's a little bit more to it, it wasn't clear that it made sense absolutely to put on capacity and that you could hedge out that risk. So we go into the month of February with extremely tight energy conditions. You've got coal starting to shoot up like crazy because it is supplementing some of the weakness in supply in that gas. And then oil is even being used in some cases, which is not always or even typically the thing that you would use to power the utilities. It was a very cold winter and it was extremely, extremely strange conditions. And then you start to have this conflict in Russia and Ukraine. I think it's been very well reported how much Europe depends on oil and nat gas from Russia. And now they're going to have to get it from somewhere else. So the removal of Russia in some cases is as high as 40% reduction in the energy mix for a number of countries throughout continental Europe. Now, how will this resolve? What will happen next? I have no idea. The markets are that way, but there are a few things that I can say that may help you think through what you want to do next in your portfolio positioning. The first is that the back part of the curve, while it is still in backwardation, has lifted up significantly. We are getting kind of a $90 range for some of the summer months. I think people are a little worried that it might get warm, but only Mother Nature can really tell us what's going to happen there. As we go farther back, we're well into the 80s, and in some cases, we're in the low 90s. So absolutely, at this point, there's less of that, I don't want to necessarily do CapEx because I'm not 100% sure how to think about the profitability of those projects. So I do think that we will have oil come on and some of those things are alleviated. That said, it takes a little bit of time. So in that regard, I do see the companies, knock on wood, this quarter telling us that they are in fact going to increase production. And hopefully that'll give us a little bit of a break on oil prices going up any further. Now, it's not Amazon Prime. You can't just dial it up and suddenly it's all pumped out and traveling across the United States into the rest of the globe. So we will get a little bit more clarity on how much production and what it might mean. Now, I want to mention that Mother Nature plays a huge role in whether we're going to be lucky or we're going to have a problem. It is, as the making of this video, still the end of April, and it's been known to go crazy cold or crazy hot in the month of May. If we can have mild temperatures across the globe, by the way, in May, and we can start out June with mild temperatures and not a crazy hot summer, then we might be able to make up some of this production shortfall that's been happening and allow our production in the United States to supplement some of the weakness in production and the weakness in oil and gas, free trade, if you will, across the globe. But it will be touch and go because let's just face it, Mother Nature doesn't care what's going on in the human world. So if she just decides to have a rip-roaring hot summer, it could be bad. Now, there are definitely a lot of factors to consider. There's a lot of geopolitics, particularly in Latin America and in the Middle East, that could potentially bring more supply on or reduce supply. It's always very touch and go. But I think that might be beyond the scope of just trying to understand backwardation in the context of today. Hopefully this tutorial has given you a better understanding of how to think about oil backwardation. Now that's all I've got prepared for this session. If it was helpful to you, please do like the video, share, comment below, and let me know what was helpful. Let me know if there were things that you wanted me to answer, and definitely it'd be amazing if you would subscribe to my station. Until next time, good luck in these markets.